So the amount of times I've been stopped out as a trader, in these moves, only for the real move to happen, is one of the most annoying things, right? So the first thing to understand when you're trading a choppy market is you need to be willing to let your trades breathe. And so what I mean by that is you need to be having slightly wider stop losses instead of those tighter stop losses. Those tighter stop losses will give you a higher risk to reward, when in reality, what you want is a winning trade. Now, chasing a higher risk to reward often will yield you the opposite results of getting a winning trade. Simply put, if you're trading a range, increase your stop size, right? It is that simple. If you find yourself getting to a fair value gap or a support and resistance and you don't really know what's happening, you're leaving your trading to chance, i.e. So a quick way to avoid gambling is to understand what is going on at key levels, right? So what's interesting here, if we kind of dive into these candles a little bit, what I want traders to understand is we are going to be breaking down the science and the logic behind this. And if you can understand how a candle works, you'll be able to trade any market, any session, and avoid getting chopped out. All you need is three things to make this a consistently profitable and mechanical strategy. You need to know where to trade from, what to look for, and why you are looking for it. Where, what, why. And if there's nothing you take away from this video, is you want to understand at this level, buyers are in control, right? So these aggressive sellers could not really sustain price lower, because if these aggressive sellers over here were successful, they would have broken price below the Asian range, but they didn't. An absorption of sellers, simply put, simply means that sellers are not in control. But your job as a trader is to identify key levels, entry at key levels, and you want to see whether your key level is going to be a demand or a supply. The only way you can see whether you're at a supply zone, or in this case a demand zone, is by understanding aggressive sellers have failed. They have been absorbed by passive buyers, right? So approaching a rangy market is the easiest thing, right? You need a key level of a 15-minute fair value gap, and understanding that the market will gravitate towards these key levels and give you multiple opportunities, right? So breaking this down one more time, when you see 516 for 98, and then you see price breaking to the upside on 1-2 occasions, you can take a long anywhere from this position, because what you've seen is a massive absorption of a large number of sellers, which shows you sellers have been rejected, which shows you that there's passive buyers at this level, which shows you that there's passive buy limit orders at this level, which tells you you want to be buying. So this is one way to avoid getting chopped out in choppy markets, is to understand exactly where the limit orders are actually present.